if you don't do something, if you don't pick something that's kind of conducive with your other parts of your life, again, your interests, your skill set, your time, the amount of money you have, the amount of effort you're willing to put in, you're going to find yourself doing something that may be financially optimal, but you're going to destroy the rest of your life in pursuit of that thing because it just doesn't fit in with whatever else you're doing.
There is a new American dream, one that doesn't involve working till you're 65 before you start enjoying life. If you're someone looking for ways to regain control over your time and check off that bucket list now, you're in the right place. We share tips from experts on investing, personal finance, and mindset so that you can finally have the freedom to work less and live more. This is the Freedom Investing Podcast with your host, Chris Toribio.
What's going on, everyone? This is Chris Toribio with the Freedom Investing Podcast, and I'm so happy you're here to join us for another amazing episode. If this is your first time tuning in, welcome to the show. Please make sure to hit that subscribe button so that you can stay up to date with our latest episodes. Moving on to today's guest, we have Jay Scott. Jay Scott is an entrepreneur, an investor, advisor, author, and partner at Bar Down Investments, focusing on buying and repositioning large multifamily properties. In the past 14 years, Jay has bought, built, rehabbed, sold, lent on, and held over $150 million in property around the country. After a prominent technology career, Jay still participates as a strategic advisor for several venture-backed companies in the real estate space, in addition to mentoring aspiring active multifamily investors in the coaching program he co-founded, Apartment Addicts. He is also the author of 5 BiggerPockets books on real estate investing, including the bestseller, The Book on Flipping Houses. Jay, welcome to the show, my friend. Before we dive into it, give us a quick 2-minute rundown of who you are, your background, and where you are in your journey to achieving time freedom.
Thanks so much, Chris. Thrilled to be here. I've been looking forward to this since we got to hang out last summer in Chicago for a few days. So thanks for having me on. Excuse me. I started my career as an engineer and business guy in the tech world. 2008, my wife and I decided to get married. We realized that the 80-hour weeks, the ridiculous travel that we were doing with respect to our day jobs just wasn't conducive to starting a family and growing a family. So we made the decision to quit our jobs, and we moved from the West Coast back to the East Coast, and somehow we fell into real estate back in 2008. Luckily, I didn't know much about real estate because had I known more, I probably wouldn't have started investing in 2008. But it ended up working out well for us. We did single family for a long time. And then about 5 years ago, we transitioned into multifamily. And so these days we are doing large multifamily syndication and basically all things residential.
I love that. And you have quite the history here when it comes to your real estate investments. I really want to kind of break down that background a little bit more, though. So it sounds like both you and Carol, for those who don't know, Carol Scott's his wife. And so for those who don't know, you guys were working these 80-hour work weeks. You were living on the West Coast. You transitioned out of that market into somewhere that was potentially a little bit more affordable, something that allowed you to have a little bit more financial capabilities to do some more investment strategies. I guess, what did that kind of look like to position yourself to start investing in real estate in the first place?
So it's funny because nothing we ever did was with the goal of positioning ourselves to be investors. Honestly, when we made that leap, so I mean, we were fortunate. We had done well in the tech world, so we did have some cash kind of to backstop us if we had any slips and falls along the way. We had some cash to kind of help us get started. So we're very fortunate in that respect. But at the same time, when we got into real estate, we had no idea what we were doing. We didn't have a plan. When we left our jobs, it was very much, hey, we'll figure this out as we go along. So we kind of took a leap without putting a lot of thought or planning into it, which was good and bad. Obviously, it was bad because there were risks associated with it, but it was good because it really allowed us to kind of look at different options, whether we wanted to start a business, whether we wanted to get another job, whether we wanted to start investing, and if we were going to invest, were we going to invest in businesses or real estate or buy a franchise. So it really left the door open for us to kind of pursue whatever we thought was right at the time. And again, real estate ended up being that thing. But at the time, we didn't know that. So for us, it was kind of this lack of planning that gave us the opportunity to kind of explore different options. And I know a lot of people, they grow up and they think, I want to buy rentals. I want to buy apartment complexes. I want to flip houses, whatever it is. They want to do something in the real estate world. And they kind of have this laser focus without ever really thinking about, is this the right time to be doing that? Is this the right place to be doing that? Is this the right strategy to be using right now? Is this even the right industry to be in right now? Because they've made this decision on what they want to do. We kind of took the opposite and we said, let's just open ourselves up to whatever we think is a good opportunity at this time. 2008 ended up being a great opportunity for real estate. And so that was the direction we went.
I love that. And as someone who read your book, Recession Proof Real Estate Investing, I completely kind of resonate with that idea. And so you did mention, though, that you were also including businesses and potentially franchises as something that you were going to invest in or start and partake. What was kind of your mentality behind looking at any one of those, whether it be real estate, whether it be business, or whether it be franchises, that you saw as a solution to being able to leave your job?
Yeah, so we kind of dipped our toes into each of those things. So when we left our job, ultimately we decided to do a little bit of real estate investing, but at the same time, I was investigating franchises. I was talking to other people about partnering with them in their businesses, either as an active partner or just as an investor. I was looking at doing other things like angel investing and putting money into other people's businesses. I was looking at investing in other things outside of real estate, being a full-time investor, but not necessarily a real estate investor. And so there was at the end of the day, it was kind of, let's try a little bit of everything. Let's take 6 months and kind of explore and investigate and play around. At the end of the day, again, it really boils down to not just what the best financial opportunity is, but you also have to pick something that's going to be conducive to your skill set, your interests, what's going on in the rest of your life. I mean, being an entrepreneur is hard. It takes a lot of time. It takes a lot of energy. There's a lot of stress involved. And if you don't do something, if you don't pick something that's kind of conducive with your other parts of your life, again, your interests, your skill set, your time, the amount of money you have, the amount of effort you're willing to put in, you're going to find yourself doing something that may be financially optimal, but you're going to destroy the rest of your life in pursuit of that thing because it just doesn't fit in with whatever else you're doing.
I love that. Absolutely. You know, my wife and I right now, Angela, you probably remember her from the conference, but we both are exploring a bunch of different opportunities similar to what you did back then. Was, you know, we are investing in real estate. We also look at syndicating real estate as well, but we have recently been presented with an opportunity to purchase an existing business. And so what we had to do was do a little bit of personal inventory and do a little personal SWOT analysis in terms of what our strengths, our weaknesses are, what are some of the opportunities that we can take advantage of, as well as the potential threats, as well as having a clear understanding of what our why is in the first place. And as you mentioned, you know, you can be financially successful when it comes to any one of these ventures, but if it's not in alignment with what you as a person are kind of wishing for in your life, you may not be happy at the end of all of this, right? And so moving forward from here, you ultimately chose real estate investing. What did that transition kind of look like when you guys started flipping houses? What was that kind of first experience like?
Well, I think it was a lot different for us than most people. So a lot of people go into real estate as kind of a conscious decision. They say, I want to be doing real estate. Maybe they have a contractor background. Maybe they have a developer background. They came from a background of family that was in real estate investing. Maybe they had some interest in real estate investing from an early age, and so they'd studied it for years and then they jumped in. For us, literally, we were in our mid-30s. We had just bought our first house to live in, first house we'd ever purchased. I am not a handy person. I have an electrical engineering degree, but my wife would joke, half joke, that I can barely change a light bulb. And it's true. I know nothing about construction. I know nothing about renovation when we started. And so the fact that we decided to jump in, because I had so little knowledge and background in the nuts and bolts of real estate, I was kind of forced to take a different track. And that was focusing on the business like a business owner and hiring people to do all those day-to-day things that I knew I wasn't going to be good at. So hiring somebody, obviously, to do the contracting. I wasn't going to do any of the work myself, but even managing the contractors. I didn't feel like I had enough background to even manage the contractors, put together scopes of work. I didn't feel like I could go in and inspect a house and see what was wrong and see what needed to be changed. And so I was forced to bring in other people to help me. Now, obviously, that's a harder way to start a business. It's a more expensive way to start a business. It's a more time-consuming and risky way to start a business. But it also gave me the opportunity to build a business that was much easier to scale than the typical real estate business. And it freed me up from the day-to-day being on site at the projects, or walking into Home Depot and walking the aisles at Home Depot, buying materials, or overseeing contractors, or walking new projects. It gave me the opportunity to really build my business and focus on my business as a business owner, which we talk about time freedom all the time. This was kind of the start of me building something that would eventually allow me to not completely step away, but to have a lot more time freedom than somebody who is literally working in their business day in and day out.
I love that. And, we talk about flipping houses as a very active form of real estate investing for many people. But as you said, as long as you're able to kind of systematize the things that you do on the day-to-day basis that may not be the highest and best use of your time, then you can get yourself in a position where you kind of step back from the day-to-day operations so that we can continue to scale that business. And so what did that kind of look like on a day-to-day basis for you? Once you were able to kind of put together your team, you were able to manage these rehabs either from a distance. What did it look like for you on a day-to-day basis where you were spending your time during this time?
Yeah, so I spent my time working on strategic parts of the business. So how do we scale? Basically, at the end of the day, a flipping business boils down to two really, really big pieces. Number one, finding properties, and number two, finding the money to actually purchase and renovate those properties. So at the end of the day, I divided my business into a couple different things. Number one was acquisition. So building a part of the business that could acquire properties efficiently. Number two was raising money. So bringing in capital, whether it be from partners, from banks, from hard money lenders, from whatever it was, so that I could actually do those deals. And then we had the two pieces of the business that were actually on the ground, kind of nuts and bolts, which was performing the renovations and then getting the property sold after we renovated them. And so my wife and I were partners, and we decided let's kind of split up the tasks. So I focused on the renovations piece and the capital raising piece. She focused on the acquisitions piece and the selling piece on the back end. And we both kind of looked at these four buckets and we said, okay, how can we kind of put each of these four buckets on autopilot? How can we systematize things? How can we build processes around them? How can we bring in people to help us automate those pieces of the business? And so we focused on our business as kind of four separate little businesses because those were the four big components. And for each of those four components, we really figured out how we could, to the best of our ability, automate and systematize and delegate so that we didn't have to be day to day in each of those four parts of the business.
That's fantastic. And I wanted to ask, like, when it came to the peak of your house flipping business, what did that kind of look like? How many projects did you have going on at any given time?
I think the most we did in 1 year was 45 projects, which I know there are a lot of people out there that are doing a whole lot more than that. But this was back, the height of when we were flipping was 2009, 10, 11, when it was actually really easy to buy projects, but we were still pretty conservative because it was really hard to sell them. It was hard to find those buyers. And if you could find the buyers, you could find the one or two or three buyers in your market. You'd find that half of them probably couldn't get financing, or their financing would fall through 3 times before they could eventually get their financing. And so for us, it wasn't so much like these days, the difficulty of scaling on finding the great deals. You can find great deals if you put more work in, if you send more direct mail, if you knock on more doors, if you talk to more realtors, if you look at more properties, you talk to more banks. It's easier to scale that acquisition side of the business than it is to scale the disbursement side of the business, the selling of properties, because at the end of the day, demand is going to be limited. Supply tends to be less limited than demand. And so we didn't want to buy 100 or 150 properties in a year when literally in the market we were in, there were only 30 or 40 buyers in a year. And so we eventually had to go out to different markets and scale that way. But the volume we were doing I thought it was pretty big at the time. We didn't know too many house flippers that were doing more volume than we were doing at the time. But as the markets improved over the years, certainly we're seeing people doing a whole lot more volume.
Yeah, I mean that's incredible. Assuming there's 52 weeks in a year and you guys are doing somewhere around 40, that's almost one property per week that you guys were kind of working on at any given time. That's incredible. And so fast forward, right? So you guys you had this house flipping business for how many years before you guys kind of transitioned into the multifamily space?
So it was about 8 years, so 2008 to about 2016. In 2016, I started to get a little bit burned out, and I started thinking about doing other things. I think I started a technology business with a friend of mine. Excuse me. And we were focusing on some other things. In 2016, 2017, we started focusing on some other things outside of real estate. We were still flipping houses, but it wasn't our primary focus. And it was around that time that I realized that long term, this just didn't fit my interests anymore. I was a little bit burned out and I had to find something else. And so 2016, 2017 were kind of transition years for us where we started to think about what's going to be next. Is it going to be in real estate? Is it going to be somewhere back in business? Is it going to be technology? Is it going to be investing, but investing in some other asset classes? We didn't know. So we took about 2 years to kind of really think about where we wanted to go. 2017, 18 comes around. And at that point, I'm thinking that we're likely heading into a recession in the next year or two. So I was expecting 2019, 2020 to be kind of the year of a big recession. COVID I guess we sort of saw a recession in 2020, but it was short-lived and COVID kind of changed all that. But thinking we're heading into a recession leading into 2019, 2020 made me start to think about what asset classes do I want to be invested in should we experience an economic downturn? Should things kind of go to crap? Where do I want my money to be? Where do I want my time to be? That was around the time that I wrote the book, Recession-Proof Real Estate Investing. And one of the common themes I kept coming across was that multifamily was a great place to be throughout a recession. 2008, multifamily took a big hit, but was more resilient than most other asset classes. Then you go back to 2001, 1992, late 80s, early 80s. Multifamily was always that asset class that tended to be more resilient than other asset classes during the downturn. And so I really thought this is where I want to be if we're heading into a recession, especially if it's going to be a big recession. I want to be in multifamily. I started thinking about I could invest with other people. I could take my cash and put it into syndications as a passive investor. But I'm a control freak. So at that point, my thought was if I'm going to be investing my money in multifamily, I want it to be deals that I'm controlling. And so I decided to move into multifamily myself and kind of make that the next iteration of my real estate career.
That's fantastic. And I kind of want to rewind there because you had mentioned that back in 2016, 2017, and as we lead into, the subsequent years into COVID, you had noticed that there were some economic indicators that may have hinted that we were heading towards a recession. Now, for those people who didn't read your book, what are some of those things that people would start looking at that may indicate that we may be heading into an economic downturn?
Yeah, so there are a few things that I like to look at. So the first is just timing. It's not very quantitative, but one thing that we recognized over the last 160 years of the true economy in this country is that, and not just the last 160 years, but literally thousands of years, what we've recognized is that economies are cyclical. They go up, they go down, they go up, they go down, and they tend to happen on a regular basis. Over modern history, again, the last 100, 150, 160 years, what we've seen is that our economy tends to go up and down in a full cycle on average every 5 to 6 years. So over the last 160 years, we've had 34 recessions. So you divide 160 by 34 and you see 5 to 6 years is kind of about maybe even a little bit less where we tend to see a full economic cycle. So 2008, we obviously saw a huge downturn. And then we spent a good 10 years up until about 2018 when I was thinking about this kind of on an economic incline. an expansion, as we call it, where everything's going well. Well, 10 years into an economic expansion is a really long time. And in fact, it was the longest we'd ever seen in history. So just from a purely historical timing perspective, the fact that we were 10 years into this kind of bull market, both the stock market, real estate, other asset classes, was a good indication that we're probably coming to the end of that cycle. Now, even absent of, or perhaps not even, but absent other indicators, that's a good reason to think you might be coming towards the end of an economic cycle. Just the fact that it's been really, really long that we've seen this upswing. But in addition, we also started seeing some quantitative metrics that were indicating we might be heading towards the end of the economic cycle. So I was watching at the time GDP, so our gross domestic product, which is kind of the total output of the country. So how much goods and services we're producing and putting out there. And what we started to see in 2018 was that GDP was starting to drop a little bit. We started to see unemployment blip up a little bit starting in 2018. A big thing that we saw is this thing called an inverted yield curve. And a yield curve is just a representation of bond rates over different periods of time. And those bond rates tend to change in very predictable ways when investors start to get worried about the economy. And we started to see these changes in the bond curve that indicated some investors were starting to get nervous around 2018. And so that's typically a pretty good indicator that within a year or two, you're probably heading into a recession. And then there are a whole bunch of other indicators that you can look at. And again, I wrote a whole book on the topic. I'm not going to bore people with the details, but all the indicators, or many of the indicators that we're seeing, were starting to soften. We're starting to indicate that likely within the next year or two, we were probably going to see the end of this era, this end of this bull run. And so 2018-ish, obviously I was guessing. I didn't know it was possible. It could have been 10 more years before we saw a recession. But at that point, I was comfortable enough to say I'm willing to put my money on the fact that by 2019, 2020, we'd likely be somewhere in that negative territory for economic growth.
Absolutely. And then here comes 2020 and we get hit with this black swan event and everything kind of shuts down. And investors, so many investors in our network, when we were taking a look at what was going on, was really in a wait and see type of phase. I guess, what were you doing during that time once COVID hit, and how did you kind of shift your strategy during that brief period of time? Well, I wouldn't even say it was a brief period of time. It was about a year or two that we were all kind of cooped up inside the house there.
Yeah. So well, it's funny because you look back and you realize that COVID, in a way, was kind of a year and a half of misery cooped up in our houses. Like you said, everybody was shut down. But at the same time, there were some very definitive sections of time. So you look at like the March, April, May of COVID, right after it started, and we saw this like total economic collapse. So the stock market dropped by about 50%, and real estate transactions just stopped. We basically couldn't buy toilet paper. I mean, I know people remember this, but if anybody's listening to this episode 10 years from now, and they're thinking, oh, I wonder what it was like. Yeah, literally, you walk into the store, you couldn't buy toilet paper. And so it was crazy. Everything shut down. And at that point, I was really scared. At that point, I really thought that, okay, we could be 10 years into this recovery once we get through COVID. And so I stopped doing everything. We actually had a large multifamily under contract in February of 2020 that we basically reached out to the seller and said, look, we just can't move forward with this. Only time we've ever done that. Only time we've ever backed out of a deal. And at the time, I was thinking it could be a year or 2 or 3 or 5 before we do another deal. So that was kind of February, March, April, May. Then you get into the summer of COVID, and suddenly it's looking like, okay, things are bad. But the government hasn't shut down. They're starting to print a lot of money. They're starting to send out relief checks. People are surviving, not thriving, but they're surviving. But that was kind of the first indication that, okay, maybe we're not heading towards societal and economic collapse. And so by the summer of 2020, I said, okay, well, maybe now is a good time to actually start buying. Things are on sale. We can get discounts on some properties. It might be a risk. It might be a few years before values return, and and we can really feel comfortable renting out these properties long term. But interest rates had gone to basically zero at that point. And so summer of 2020, I'm thinking, okay, this might be an opportunity. That deal that we had backed out on in February, we actually got back under contract at a nice little discount. September 2020, we purchased that large multifamily, bought a bunch of single family houses. And 2020 leading into 2021 was kind of one of those, okay, let's take a risk. Then you get into 2021, and the whole of 2021 and beginning of 2022 is kind of, okay, everybody's got all this money and all of these asset classes are starting to explode. And we're starting to think, okay, where's the top here? And now I'm starting to get worried again, thinking, okay, I had a great buying opportunity for a couple months, but maybe now it's too late again. And so for pretty much all of 2021 and beginning of 2022, we bought cautiously, but we didn't buy a lot. Because I think everybody saw that this kind of run up in asset values just couldn't last. And then here we are in 2022, and it feels like, okay, we've peaked. In some markets, we're starting to see a downturn in rental prices and real estate values. We're starting to see the stock market soften, even though it's not really gone down tremendously over the last few months. And right now, it feels like we're in a holding pattern. So there are these very distinct periods after COVID. I mean, a lot of people like to think of it as a year and a half of COVID, but from an investing standpoint, it was tremendous fear to opportunity to confusion. And I think we're still in that confusion space right now where nobody really knows where things are headed. Are we headed towards a big downturn at this point, a little downturn at this point? Or are we going to stay in a holding pattern and not see a downturn for another year or two? Nobody really knows.
Absolutely. Yeah. It's very tough to truly predict what it is that's going to be happening. But as you mentioned, and I kind of want to drive this point home to our listeners as well, is like, if you are able to educate yourself on the different types of economic hints that can point you in the right direction in terms of whether or not this economy is going to continue its upswing, continue its downswing. And I want to preface this by saying that there's no way to completely tell the future, but the best thing that you can do for yourself and for your business is to at least take an educated guess based off of specific metrics that we can use to help guide our investment decisions there.
But I think this is worth mentioning. We can't predict the future. None of us can. And what we've seen with 2008, with the 12 years after 2008, with COVID, what happened after COVID, we're always going to be surprised. We're never going to know exactly what's going to happen. But one of the nice things that we have 160 years into this economy in this country is a lot of data points, historical data points. And using those historical data points, we can kind of, we can guess at very least where things are likely to head. So, for example, we talk a lot about interest rates being up right now, and people very concerned about our interest rates going to go to 10%. Are they going to stay there for the next 20 years? What's going to happen with interest rates? Well, we can look at the history of interest rates in this country, and we can see what's happened the last 10 times we've started raising interest rates. How long did they stay high? How high did they go? How long did it take for them to drop? What happened in the intermediary period between them going up and coming back down? And so we can see these definitive patterns, which helps us kind of at very least say, we don't know what's going to happen this time, but we do know what happened the last 10 times. And if history is any indication, here's what's most likely to happen. And so just to complete that thought with interest rates, over the last 10 cycles of rates increasing, what we've seen is the average amount of time for rates to increase before the Fed realizes that they're hurting the economy and we're going into a recession by increasing rates is an average of 2.2 years. So last 10 times that the Fed started hiking rates, with an average of 2.2 years, the Fed started dropping rates. The most was about 3.5 years. So unless this time is significantly different than the last 10 times the Fed hiked rates, and I'm not saying it's not, it might be, but if you believe this time is just one of those same as the last 10 times, then within 3.5 years of the Fed hiking rates, we should see rates come down. And on average, it should be within about 2.2 years of the Fed starting to hike rates. So Fed started hiking rates at the beginning of 2022. That tells me that probably by 2024, summer of 2024, there's a reasonable chance that we're going to be in a recession and the Fed's going to start dropping rates. And so again, it's just a guess, but using historical data, I think it's a very reasonable guess. And we can do that in all parts of the economy. And when you start thinking in terms of how did this end in the past, the last 5 or 10 or 20 times that we were in this economic situation, how did it end? It really gives us some clarity on what's likely to happen. And it also gives us a roadmap towards what we should be doing now to prepare for the likelihood of whatever is going to happen.
Absolutely. And that's the thing too, is you right now it's very difficult for deals to pencil out because as you're saying, the Fed has been increasing rates. They have already admitted to continue increasing rates over the course of 2023. And truthfully, when it comes to cap rates and the current pricing in the market, we haven't truly seen too much of a correction, if at all, when it comes to the pricing of these assets in the market right now. And so I know that takes some time for it to kind of catch up as well. And as you're saying, the rates go up anywhere from 2.5 to 3.5 years. But once rates start coming down, in the past, I guess, how long has it taken for the market to kind of get back to where it was pre-recession?
Yes. So, and there's a lot of good data there as well. So number one, what we've seen is that it can take a year or two for rates to increase to the point where we actually see a decent recession. And the reason for this is, obviously, as rates go up, two things happen. One, people have more of an incentive to save. So as your yields on your savings accounts or your CDs or your bonds increase, you have much less incentive to spend money, more incentive to save. Like right now, you can get 4% on treasury bills. You can get 4% on some CDs, and even savings accounts are above 3%. And so people are starting to save money, hopefully. But in theory, people are going to save more money. Number two, as interest rates go up, it gets much more expensive to borrow money on credit cards, to take out mortgages, to take out car loans. And so people tend to spend a lot less money because it's more expensive to spend money on credit. And so between those two things, people saving more and spending less, the economy slows down. And so raising interest rates tends to put us in a recession. And so what we typically see, again, is a year to 2, maybe 3 between the time the Fed starts hiking rates and the time we go into that recession. But also what we see is once the Fed realizes that things are bad, we're in a recession, and they need to take action to improve things. First, the way they improve things is they lower interest rates. But what we've seen is they tend to lower interest rates a whole lot faster than they raise them. And so it might take a year or 2 or 3 to increase interest rates, but typically we're going to see a drop within about 6 months of back to where interest rates previously were. Now, I'm not sure we'll see interest rates go back down to 0, but I think there's a reasonable chance that once the Fed recognizes that they have to start dropping interest rates because we get into a recession, that they're probably within 6 months, we're going to see a significant drop in interest rates. So in terms of how long is this period going to last, I think likely 2 to 3 years of increased interest rates and another 6 to 12 months for interest rates to come back down. So I think by 2025, we're going to see interest rates back, if not where they were during COVID, because obviously that was kind of an anomaly. I could see interest rates back to where they were pre-COVID by 2025. Additionally, if you look at a typical pattern of a recession, the expansion period of the economic cycle, that market's going up, typically is about 3/4 to 40 to 80% of the entire cycle. The recession typically only lasts about 20 to 25% of that cycle. So the recession tends to be a whole lot shorter than the run-up. And so if in a typical cycle, we're talking 6 years for a full cycle, and the recession part is 20 to 25% of that, that means 6 to 18 months of recession. So at the point where we say we're in a recession, and I know a lot of people thought we were there last summer, a lot of people think we're there today. It really, I'm not going to argue over the definition of recession and where we are, but it's reasonable to think that once you believe we're in a recession, we're probably there for 6 to 18 months. So even if we're not there right now, even if it takes us a few more months to get there, that still puts us at 2024, 2025 for us to be kind of out of this upcoming economic downturn. So no matter how you look at it, I'm pretty confident that come 2025, we're probably going to be in a good position again.
Very good insights there. And so I want to kind of fast forward. Let's say we're in 2024, early 2025. Rates have slowly started coming back down over the course of anywhere from like 6 months or so. Now, as far as buyer confidence and new development starting to increase again and activity starting to take more place, does that typically respond pretty quickly to those rate drops in terms of action starting to take more place in the marketplace again?
So that's a good question. And what we've seen is different recessions tend to react differently in terms of the rebound on the other side. Psychology often is related to the depths and the pain of that particular recession. So 2008 was actually a very long recovery, but again, that was because of the depth and the pain that we saw in 2008. I mean, in many places, we were in 2013 and prices were still coming back. We were kind of still pre-recession pricing in 2013 in a lot of areas. But you go back to, again, previous recessions, 2001, the early 90s, the late 80s, 4 recessions between 1968 and 1982. And in each of those, they were typically pretty quick rebounds. And so, again, we don't know how deep and how painful this upcoming recession is going to be. But assuming that it's a typical recession, we'll probably see a pretty quick rebound as well.
Love that. Love that. So let's say I'm a new investor right now, right? Let's say I'm in a similar position that you were back in 2008. I'm looking for an opportunity to quit my job. I want to start investing, whether that be in a business or whether that be in real estate asset class. And I want to start. Would you suggest to them, knowing all of this information, to simply wait until 2025 before they get started with any sort of real estate investing? What strategy would you give to them?
Yeah. So one, don't wait. But that doesn't mean run out today and start buying property. I think there's an in-between, both in terms of timing and in terms of action. So from an action standpoint, there's a lot of things people can be doing today, even if I wouldn't recommend running out and buying property. So number one, study, research, learn. Now's a great opportunity to spend the next 6 to 12 months really reading everything you can get your hands on, listening to every podcast you can listen to. Go back and listen to every episode of this podcast. Go back and listen to every episode of the BiggerPockets real estate podcast. Go listen to all the other podcasts out there. Go read books out there. Go look at forums and talk to other investors. Start spending times at real estate investor meetups and real estate clubs and other investing meetups and business meetups. Now is a great time to really be building your knowledge base, because I see too many people that are like, now's not a good time to invest. So they don't do anything. And then one day they wake up and they say, now's a good time to invest. Oh, damn, I don't know what I'm doing. I have to spend the next 6 to 12 months. Well, now's that 6 to 12 months that you should be learning, so that when the opportunities start to come, you're ready to respond. Number two, start building relationships with other investors that may become your partners, relationships with lenders, and people that have money that could eventually become the people that are financing your deals, relationships with contractors, relationships with vendors, relationships with agents, relationships with everybody in the industry that you're going to want to have when you're ready to take action. Basically, when the time comes that you're ready to take action, you want to have the money ready. You want to have access to the deals ready. You want to have the knowledge ready. You want to have everything ready. So now's a great time to be focused on building those relationships. Finally, build up whatever it takes for you to actually have the resources to be able to move forward. So you have bad credit. Well, now's a great time to be focused on rebuilding your credit. You don't have enough credit. Now's a great time for you to focus on how you can expand your credit lines. I'm a big fan of saying always be increasing your credit lines on your credit card, on your home HELOC, on everything. Don't necessarily take that money out. I'm not a big fan of using credit, but I'm a big fan of having it available in case you ever might need it. And so now's a great time to be focused on doing that. So now's a great time to be doing a whole lot of things that doesn't involve actually going out and buying property. Now, the second piece is, when do we go out and actually buy property? Well, the answer is, if you're focused on learning, you should also be focused on looking at deals. And so I tell everybody, look at deals from day one. Even if you don't know what you're doing, look at deals. Make ridiculously low offers. Make offers that you may not know what you're doing, but the offers are so low that you know that if somebody happens to say yes, it's going to be a good deal. Or have a contingency in the contract that you can back out. But get used to making offers, because at the end of the day, we are successful in this business because we make lots of offers. So people need to get comfortable with the process of making offers. They need to get comfortable with the process of getting rejected, those offers rejected. They need to be comfortable with the process of negotiating after they've been rejected. And so when the deals start coming along, you're not like, I don't know how to make an offer. I'm not comfortable making an offer. I'm not comfortable being rejected. Hopefully you've been rejected 500 times by the time you get that first deal, because you'll really be ready for it. So start making offers and be conservative. And when the market changes, and I have a feeling it will over the next 6 to 12 months, when the market changes, start looking for those opportunities, and they'll appear. And if you've built a good network and you've learned and you've set yourself up for success, you're going to be one of those few people that are really ready to take advantage of this next part of the economic cycle, where I have a feeling a whole lot of people are going to be making a lot of money.
I love that. That was a great summary there, Jay, and I really appreciate that. And I know we're headed towards the end of today's show. Before we have the Freedom Five, I did want to quickly touch base on a topic with regards to business. Now, I know most of these economic insights have related to someone who invests in real estate, but what if someone's looking to purchase a business? So we'll have someone looking to start a business. Do these same concepts kind of apply?
Yeah, absolutely. So at the end of the day, real estate is a business. And so when we invest in real estate, we can do it in all the same ways we invest in businesses. We can be active investors, so we can participate day to day. We can be passive investors, where we just kind of put the money in and we let other people do the work, or we can be somewhere in between. And so the first thing to do is really figure out, if you're going to buy a business, or if you're going to invest in a business, or if you're going to partner in a business, you need to figure out, to what degree do you want to be active versus passive? To what degree do you want to just put money in and hopefully get money out, or do you want to put your time, knowledge, and sweat into? At the end of the day, we have three things we can put into any venture we do, and we have time, we have money, and we have expertise. And you need to figure out which percentages you have of each. If you have lots of money but you have no time or expertise, well, you're the passive investor that's throwing money at things. If you've got the expertise, but you don't have the time or the money, well, then you're the consultant. And if you don't have the expertise and you don't have the money, but you have lots of time, well, then you should be going out and saying, hey, how can I intern for you? How can I help you for a piece of equity in your business, or a piece of equity in your investment? And so think about time, money, expertise. Which do you have and in which proportions? And that kind of gives you an idea of how you're going to end up participating in whatever venture you're going to do. But at the end of the day, again, businesses are very much the same as real estate. These are all businesses, and you need to figure out what role you want to have, and then pursue that activity with that in mind.
Amazing insights there, Jay. Appreciate that. All right, folks. Well, we're coming towards the end of today's show, but before we finish, it is time for the Freedom Five. These are 5 questions that we ask every guest on our show, starting with the most important question: what is your why? What is the underlying motivation behind everything it is that you do?
For me, it's knowing that if for some reason I wasn't here tomorrow, my family would be taken care of. So for me, I spent a long time really working as hard as I could to build up a nest egg that I felt like, okay, if something happened, if I got hit by a bus tomorrow, I would never have to worry about my wife or my kids being able to take care of themselves and build a life for themselves. And so for me, that's kind of been my why for a long time. Now that I've kind of gotten to that point, I'm starting to think about a bigger why. How can I improve the world? And so we can talk about that on another show, but I'd say for anybody, your why should change over time, because hopefully at some point you've kind of satisfied that why, or you've started to satisfy that why, and now you should be doing bigger things. And I think for a lot of us, the why starts out as focused on us and our family. But at some point when you achieve that why, you should start to focus on other people and doing bigger things.
Love that. Second question we have: what book has had the largest influence on your life?
There's a book called The Goals, Goal, and it's written by an Israeli guy named Ilya. I can't even think of his name. I'm in the back of my bookshelf right there. But it's a book all about process improvement. It's a book about being more efficient in whatever you're doing, basically figuring out where the roadblock in your business is, and overcoming that roadblock, then figuring out where the next big roadblock is and overcoming that. And it's basically a book all about continuous process and systems improvement to allow you to build and scale your business. And It's not a real estate book. It's not even an investing book. It's really a book. It's a story. It's a narrative. But I highly recommend anybody that focuses on building a business or a real estate company or an investing company should read that book.
I love that. And as someone who's running a business and has seen my parents go through the process of owning and operating a business and the ups and downs that come along with that, I'm definitely going to have to check that one out.
Awesome.
All right. Third question we have here. What is the most impactful thing, whether it's a piece of technology, a habit, or a person that has helped in freeing up your time?
So for me, it really is the 80-20. I think I'm pretty good at getting a lot of stuff done in a relatively small amount of time. People often are surprised at how much I accomplish, but for me, I'm a perfectionist. I always strive for perfection, but I always am good at cutting myself off and saying, this is good enough for now. This is 80% of the way there, and time to move on to the next thing. And if something's really important, then the next step is to delegate it or to bring in somebody else that can help get it from 80 to 100%. But for me, I try and get, I abide by the 80-20 rule, and I really focus on getting everything to be good enough and then moving on to the next thing. And again, if something needs more time or attention, somebody else can finish it up.
Love that. Fourth question we have here. What is the number one piece of advice you would give to anyone looking to achieve more control over their time?
So something that's worked for me really well is I don't work when I'm not feeling energized to work. I know a lot of people, this was always a problem in my day job when I was in the tech world. It's like you have to work 5. I was working sometimes 6 days a week, sometimes 10 or 12 hours a day. And you wake up one morning and you feel like, I'm not feeling this. I'm tired. I need a break. I need to recharge. And you don't get to do that. You still have to go into work and you still have to do your job. And so the next day you wake up and you feel even worse. You went from tired to exhausted. The next day you feel even worse and you never have a chance to recharge your batteries. For me, if I wake up, and this is one of the nice things about being self-employed, owning my own business, if I wake up one day and I feel like I'm not feeling it today, I need to recharge, I take the day off. I clear my schedule. I'll spend the day with my family, with my kids. I'll go to lunch with my wife. I'll go sit in a coffee shop and read a book for the day so that I know the next day I'm going to get up feeling good and be ready to get back at it. And so instead of compounding that feeling drained over multiple days or multiple weeks, I try and get it out of my system in one day. And so I highly recommend anybody, if you wake up one day and you feel like I'm not going to accomplish anything today, don't waste your time sitting in front of the computer, because not only are you not going to accomplish anything, you're probably not going to accomplish anything the next day or the day after either.
Wow, that is incredible insights there. And as we know, entrepreneurship is a marathon, not a sprint. And so taking inventory and taking care of your own personal health and well-being is crucial to making sure that you're successful over the long term, because that's really what it is. It's a long-term play. All right, Jay, fifth and final question we have here. What is the best way for our listeners to get in contact with you?
Yeah, so if anybody wants to contact me, learn more about me, invest with me, whatever it is, www.connectwithjayscott.com, just the letter J, www.connectwithjayscott, and that'll link you out to everywhere you need to go.
Love that. Well, Jay, tons of amazing information today. I know we have to have you back at some point in the future. I love how you talked about your transition from the W-2 in the tech industry to jumping straight into the real estate investing business. I love the systems and processes that you shared to help make it so that way you don't have to be in there in the day-to-day basis every single day. And I loved how you really talked about the economic insights and how that played into your investment strategy over the course of the next few years. I love how you also gave advice for newer investors on how they can best make the use of their time in today's economy so they can be successful when the opportunity arises. I just want to thank you so much for being a fantastic guest on our show, and I really look forward to remaining in touch.
Thanks, Chris. This has been great.
Now, if you like this show and want to learn more about how we can help you free up your time through passive real estate investments, check out www.freedominvesting.com. Make sure to subscribe to our monthly newsletter and schedule an introductory call with our team. We also have a free 7-day course on what passive real estate investing is and how to get started so that you can start your journey towards earning back more time in your life. To all of our amazing listeners here on the Freedom Investing Podcast, my name is Chris Toribio. Till next time.